All right, we are live. So guys, one of the most common questions I get out there is, how often should I be investing into my portfolio? How much should I be investing in my portfolio? And when I do that, when I transfer the money into my brokerage account, what should I do with it? Which stock should I buy and how should I go about that? So that's what we're going to be talking about in today's video. And spoiler alert, there's no one-size-fits-all approach, but I'm going to share with you how I dollar cost average and contribute money into my portfolio, how often I do it, and what that looks like. And I'll share some examples of how some of you out there in the community do it as well. But before we get into all of that, welcome back to another Dividend Happy Hour. We're going on number 26, I believe. So guys, we are definitely getting up there in numbers, and I'm stoked to be back with you for another week. I always look forward to these every single Friday, and I got to let you know just ahead of time, just while we're here. I hate to let you guys down, but I do have a hard stop tonight at 5:45. We will not be able to go for the full hour, unfortunately. Hope you guys forgive me, but we're still going to have a fun episode, and tonight I'm going cold classic. I got my my margarita here, so let's do a quick cheers, guys. Let's cheers to... Let's see, it's December 2nd, so let's cheers to another good month in the books. If you guys are like me, you're sitting on all-time highs in your portfolio right now. And if you guys saw my last video from a couple days ago, you'll know that I just came off of last month was a brand new dividend income record for me. So there's a lot to celebrate tonight. And I hope you guys had a great month of income as well. So hey, cheers to a good November. Let's finish out the year 2022 even stronger. Hopefully December is going to be even better than this last month. So cheers. And real quick, let me know a couple things in the live chat. Let me know if you brought anything to drink tonight to that Dividend Happy Hour. Let me know what you're sipping on there in the live chat. Or, if you're watching the replay, sipping on something good, let us know in the comments below. And also, guys, let me know which stocks you picked up this week. I'd be curious to hear what you added to your portfolios, what you think is looking good. And the same holds true in the replay or in the comments below if you're watching the replay. Let us know what you picked up. And I'm going to put some of these... go through some of the comments so far. Just say what's up to you guys here who are here in the live stream, all 46 of you, and see maybe what you guys are drinking and what you bought for your portfolios this week. So who do we got in here? I see Coyote's in here, Kevin's in here, Big Bob's in here. We got Steven, we got Shaping, Coach Tim. Coach is here and ready for some DCA action. I love it. Caleb's here. What's going on, Caleb? Who else we got here? Charles. Charles, welcome. Good to see you. Let's keep going down here. Aussie investor tuning in from Brisbane. Brisbane? How do you pronounce that? I know it. I think I kind of screwed it up. But welcome. Glad to have you in here. I see my man Harris. B Still Sounds. Jim. What's going on, Jim? We got Paolo, Chris, Suzuki Man, Wallet Invest, Pat. The gang is all here tonight, guys. I'm so stoked to see all you guys in here. This is becoming like the Friday night ritual, huh? Dan's in here, Christian, Will, Todd, JD, Leroy. Man, good crowd tonight. Okay, so let me see what you guys picked up. So I see, well, first I'll go through some of the drinks too. We got B Still Sounds drinking a sparkling water, go Coca-Cola. Coyote, we're twinsing tonight. He's got a little marg over there as well. Bob is drinking some coffee on a Friday evening. Bob, that caffeine doesn't, well, you might be drinking decaf actually, but I know if I drank coffee this late, I'd be bouncing off the walls. You guys would not want to see that. I'm much safer here with a margarita. Let's see who else we got. Charles is drinking a Vanilla Crown on the rocks. Classic. Kevin's drinking a Busch as per usual. Let's see. And then now we're getting into some of the purchases here. Christian picked up some Apple, Microsoft, Realty Income, Johnson & Johnson. All great choices. Christian also picked up some Procter & Gamble this week. I guess not also. He picked up some Procter & Gamble. Who else we got? We got Christian got some SCHD. Can't go wrong there. Paolo got some VFC. Definitely looking cheap, that one. I actually know Harris sold out of VFC. If you guys have not listened to the most recent episode of the One Penny at a Time podcast, check it out. Harris will tell you all about that. Let's see. We got B Still, bought some BTI. Okay, Chris, good to know about that energy drink. So fun fact, guys, Chris and myself, every Friday, he'll shoot me a message with a picture of what he's drinking. And every Friday, he's got a different energy drink. And so the one he tried tonight is good. I'm glad to hear that, man. Glad to hear that. Aussie Investor picked up some Ally, some DLR, and MPW. Nice, good choices. And then JD picked up some Stag, Maine, and Apple. Todd picked up some MPW. Let's see, a couple more, then we'll get into it, guys. And then we've got Dan, who picked up some LYB, Home Depot, and SCHD. Good stuff. Good stuff, guys. Okay. And I see a handful more submissions there. I know too, if we go through them all, like we probably won't start the actual segment until like 20 minutes in, but let me take a sip real quick, guys, and we'll get into the main event. But real quick, last thing before we get into that, there's 75 of us in the live stream now. If you are just now joining, thank you for tuning in. Glad to have you along for the Dividend Happy Hour. Another fantastic live stream. These are always so much fun. Today we're talking about a handful of different ways to dollar cost average. I'm going to tell you guys how I do it in my portfolio. And then I'm also going to share, I think I have 7 other examples of how some of you guys out there in the community are doing it as well. And it's going to be interesting to see, kind of the difference, see the different approaches from person to person, and just so you guys can see, like, there really is no one size fits all. Everyone does it a little bit differently. Now, personally, how I do it, guys, I like to invest every single week into my portfolio. And what I do, just going over to the screen, this is my my dividend portfolio tracking spreadsheet. You can grab it for free. There's a link to it in the description of this video. But this nifty tool right here, guys, is the future value calculator. And what this does is this will forecast what my portfolio will look like down the road, both in terms of income, portfolio value, and share price gains, all that stuff. But like I said, guys, every single week I'm investing the same amount into my portfolio. Let me get rid of this comment right here. Sorry, guys, it's kind of blocking the view a little bit. But every single week I invest the same amount. I invest $150 into my portfolio, which on an annual basis adds up to $7,800. And this is actually going to change here pretty soon at the turn of next year, which I'll cover probably in a future video, or maybe later in this live stream I'll talk more about. But for now, guys, I'm investing $150 every single week. And if I just keep on keeping on, do this year in and year out with where my portfolio is sitting now, which is just over $42,000, by year 10, I'll be bringing in about $8,500 of dividend income, which is fantastic. That's like 8 times what I'm bringing in right now. Well, no, not 8 times. It's about 4 times what I'm bringing in right now. Excuse me. Bad math, guys. And my portfolio will be valued at about $240,000. Really not too shabby. But then if we go down another 10 years, so 20 years from now when I'm 49 years old, wow, I'll be bringing in about $22,500 of dividend income, and my portfolio will be valued at just over $700,000. Now, here's where we get to the good stuff, the juicy stuff. If we go another 10 years, 30 years into the future, just investing $150 every single week. By year 30, I'll be bringing in just over $52,000 in dividend income, and my portfolio will be valued at somewhere between 1.8 million and 1.9 million. And just to, as a kind of a side note, a disclaimer, these calculations don't take in taxes into account. It's making some very it's basically making some projections that long down the road, that might not come true. Like, I might not be seeing 8% dividend growth on average across the next 30 years. My stocks might not grow 6% or more every single year across the next 30 years. So there's a lot of assumptions we're making here, so take it with a grain of salt. But if that plays out to be true, and I try and be conservative with these numbers, that's what my portfolio is going to look like. And for me, that's great. And ideally, what I'd like to do, I'd like to increase this number over time. I'm investing $150 a week right now. I'd love, as time goes on, to increase that and speed up that compounding effect and do more with my investments. But that requires an increase of my own income, my own active income, so I can contribute more. And that's what we're working on here, guys. And that will come too. Just got to keep working, takes patience and whatever. But I really like the idea of investing every single week. For me, this fits pretty well, and that's just me. Some people like to buy every day. I know some of you out there do. Some people like to buy every week, such as myself, and then there's some other people who like to buy a little bit less frequent, maybe once a pay period or maybe even once a month. Now, switching gears and getting into some of the different ways you guys are doing it, there's some people, like I said, who kind of like me just invest the same amount on a consistent time schedule. And that's the same every single week or every month or whatever. And Harris here, just kicking things off, he invests every 2 weeks right now. He says, if most of my positions are green, I will then see who has the best valuation so I can stock up before it becomes overvalued. Consistent dollar cost averaging is the way to go. I've tried timing certain buys, and I've failed at least 75% of the time. Now, there's a couple things to hone in on here. Harris, the timing of his is a little bit different. He's once every 2 weeks. I'm once a week. But also what Harris says, he takes it a step further. Not only does he invest every 2 weeks, but from then with that money he's contributing, he's not just buying the same stocks week in and week out, which is what some people do, which we'll get to in just a moment. He's actually, and I don't even want to call it trying to time the market, but he is buying stocks that he finds to be at the best valuation. So when he invests money into his portfolio, he's looking for the best bang for his buck. What's going to help him make his money go the farthest? So that's what Harris likes to do. Moving on to this next example, this is from Gengar, who says, kind of like me, he invests every single week, just consistently increasing shares on the stocks that need the boost, and he dollar cost averages the stocks that need the help. Basically, a similar sort of thing. What he does, he'll buy every single week, but maybe not so much looking at valuation. Maybe he's just looking at the positions that are underweight in his portfolio that he wants to build up and get some more income from. So it seems to be a little bit less about valuation and more about the allocation, the weighting of the certain holdings in his portfolio. Does that make sense? And I'll go back through all of the comments here after we get through this, guys. I'm on a roll right now. But anyway, going back to the next example, Ultra Runner here says he adds the same amount of cash in his portfolio, but he sits tight. He's just waiting until he sees an exaggerated drop on a stock he wants. Now, some of you guys out there might call this timing the market, which maybe in a sense can go against dollar cost averaging, because I guess if we're breaking down the definition of dollar cost averaging, it's buying on a consistent basis, which still it seems that Ultra Runner here is doing. He's contributing to his portfolio on a consistent basis and deploying that capital within that time frame, but he's not like buying as soon as he invests that money in his portfolio. Does that make sense? He's just waiting. He's kind of fishing. He's kind of fishing until he sees, or actually hunting, I guess would be a better analogy. He's hunting, just waiting till he's got something good in his sights before he pulls the trigger. He stays locked and loaded, ready to go, and when the time is right, he's ready to strike. So that's what Ultra Runner does. Moving on, Duke here, it says Choco Jack, but we know him as Duke in the community. He usually adds money at the beginning of every month. So not once a week, okay, not once every pay period. He is once a month at the beginning of the month. And he takes somewhat of a similar approach to Ultra Runner, where if there's a stock on a down day, he buys. If not, he just holds until he sees something that is within his sights, and then he pulls the trigger and picks up some shares with that money. Okay, now moving on to the next one, guys. This, we've talked excuse me as I kind of trip over my words. We've talked about dollar cost averaging based on a set time schedule. We've talked about dollar cost averaging on a time schedule, but then waiting to deploy those funds until you see some opportunity. But then there's some others out there who, they'll invest on a set time schedule, but they're not as much worried about the valuation. They might be buying the same stocks week in and week out, no matter what the share price is doing, like Mr. Ortega, Senor Ortega here, who says, I invest in the same 10 stocks up or down every other week. I do this because in the past I held off because the stock price was high that week, only to have it continue to go up, which is kind of the inverse of what we saw from Duke. It's kind of the inverse of what we saw from Ultra Runner. But then he says, I waited for it to go down, but I missed out because it kept going up. And when you think about it, dollar cost averaging is just that, an average of the ups and downs. So Mr. Ortega, Senor here, he doesn't worry about the valuation. He doesn't really worry about what the share price is doing or trying to time it or trying to buy stocks, that seem to be at relative discounts. He's just buying the same stocks week in and week out, just keeping it simple. And also, Reen here, or Renee, I don't know how you pronounce this, kind of does the same approach. He only has 6 stocks for he or she, but tries to buy 1 share of each every month on payday. Hopefully it's a good strategy. So basically the same exact thing we saw from Senor Ortega. And then this last one here from Rant the Retort. I like to build my dividend positions for exponential growth. I buy a stock until the dividend payment buys a minimum of 1 full share. Then I start the next position. So this one's kind of interesting. This one's a little bit different than the rest because this individual is not buying based on valuation, is not really buying based on allocation either, and not buying on, how much a stock is weighted. It's more so about how much income that position is bringing in. And so Rant the Retort here will contribute to the same stocks and buy the same stocks until that stock is basically paying him, or basically with the dividends able to go and buy 1 full share, and then he'll move on to the next one, rinse and repeat. And I'm guessing what he does too is he has the drips, the automatic reinvestments turned off, so he can then deploy all of the dividends coming in into that one position to get it to that point even quicker before moving on to the next one. Does that make sense? So really, guys, all of this is to say there are so many different ways to dollar cost average into your portfolio, but really the main thing, in my opinion, guys, what's really important is this right here. It's consistency. No matter whether you buy stocks every week, no matter whether you buy every pay period or once a month, What matters is that you're doing it on a regular basis, on a consistent basis. And I think there's some people out there who might just buy annually. I don't know. They might exist. I don't know any of them, but I'm sure they're out there. And personally, I think that while there is no one size fits all approach, I do think you should, at minimum, just buy once a month. Contribute to your portfolio once a month. So just stay in the rhythm. Once a month, once every couple weeks, once a week, somewhere in that time frame. I think that's a pretty good sweet spot. Anything less than once a month, I don't want to say you're missing out, but I don't think you'll be as engaged in your portfolio as maybe a lot of us are here by buying more regularly. So that's my take on the whole dollar cost average thing. And with that, I want to know how you guys do it. How do you dollar cost average in your portfolio? I know there's some thoughts in the live chat, which I'll pull up on the screen. Let me know in the comments below if you are watching the replay. How do you dollar cost average into your portfolio? And how do you choose which stocks you're buying too? You deploy that money into your brokerage account. How do you then, choose which stocks you're going to buy from there? Let us know in the live chat and in the comments below. I'm going to take a sip of my marg real quick. And also too, if you're enjoying this live stream, there's 104 of us in here right now. If you're enjoying this, if you're having a good time, if you're enjoying my gibberish here, be sure to hit the thumbs up on this stream, hit the thumbs up on this video, and also if you're not subscribed to the channel, consider hitting that subscribe button. It'd mean the world to me. But anyway, let's go back up to these comments. I want to see how you guys are dollar cost averaging and what you have to say on the matter. Okay. Oh, actually, I know there's a really good comment here at the top that I saw before the stream even started. So let's see. Okay, Caleb, this is a pretty strong statement. It is stupid to dollar cost average, in my opinion, since you should be buying companies only under their intrinsic value, not when they are over their intrinsic value. I'm actually really glad you brought this up, and this is something I should have mentioned a little bit earlier. So there's definitely pros and cons to buying the same stocks week in and week out. Now, if you just, let's say, for example, your goal is to, what's an example? Let's say that you're just buying the same stocks, whatever, it doesn't even matter what they are. You're buying the stocks week in and week out. There's going to be some times where you're buying, and maybe it's a long period of time where you're buying that stock or those batch of stocks that you're choosing to buy, where they're not at a great value. They're going to be trading pretty expensively. Like maybe you're buying like Costco right now, or maybe you're buying something like Starbucks, for example, who just recently went back up over $100 per share. You're buying it week in and week out, even though the valuation's a bit high. Now, on one hand, it's okay, I think, but on the other hand, you could be doing better. Now, here's where it's okay. This is okay to do because really, just because of this style of investing, it is in a sense, but it's not as much about the share price. It is arguably more about getting that cash flow, getting that dividend income, right? That's kind of what a lot of us are doing this for. And so no matter what, as long as the stock is paying a dividend, no matter what price you're buying it at, you're still going to be able to benefit from that dividend. So you're still getting that cash flow. But the difference here is that if you're buying stocks when they're more expensively valued than some other ones out there, you might not be getting the best return. You might not be getting as much cash flow as you could be getting, if you bought something else that's more attractively valued. Also, by buying stocks when they're, on the up and up, it's lowering your margin of safety, right? Because the lower that you buy the stock, the lower the share price that you buy the stock at, the closer it is to zero, the greater margin of safety you have. So there is a little bit of valuation risk that you're exposing yourself to if you're not paying attention to the valuation. Now, that's kind of the con to that. But on the other hand, it does keep it simple, right? If your goal is to get 100 shares of Apple, or like we saw a moment ago, whoever it was, is just buying to get to the point where they're getting 1 share per quarter or 1 share per year just from the dividends, then it's like, okay, that's fine because you have a different goal. But if your goal is to maximize your contributions, make your dollar stretch the farthest, then paying attention to the valuation is something that you'll want to do. And that's where people like, but then again, there's a little bit of timing involved, right? But then again, that's where strategies like Dukes come into play, Ultra Runner, where they'll invest into their portfolio, but then sit on it until they see the opportunity that they want to take advantage of. And that's kind of how I do it as well. I'm buying stocks, I'm adding to my portfolio every week, and I'm buying stocks every single week. But what I am buying is different on a weekly basis. There's some that stay in the mix, like KRC. I'm buying, pretty pretty consistently right now. Intel, I picked up a lot of this last month, but I'm buying those because I think they're at an attractive valuation. On the other hand, I'm not buying Coca-Cola right now. I kind of put the pause on buying Procter & Gamble. I'm not buying any more Starbucks because those positions have run up more in share price, and they're not at as attractive valuations as some of the other stocks in my portfolio and some of the other stocks out there. So it's kind of a balance, and it just depends, I think, how this is where it becomes preferential, because you need to take the approach that I guess works for you. And like I said, there's some people who just don't care as much about valuation and don't want to get as deep in the weeds, which, to each their own, but it does come at the expense of potentially greater returns if you're not paying attention to that stuff. So, there's pros and cons there. Sorry, that was a very long-winded way to address that comment, but let's keep going, guys. I want to pull up some more of your guys' comments. So let's see. And this is actually a great point from Caleb too. We're both going to be rich as long as we are consistent with it. That's the thing. Like, that's what that's what I was trying to say. No matter which way you do it, no matter, which way you want to skin the cat, as long as you're consistent, you should see some results. You know what I mean? So anyway, Jay right here takes a very consistent approach. I buy at least one stock a day. That's the goal. And that's awesome. Like, I'd love to buy stocks every single day. Love it. Jim here says, I'll invest when there's enough free cash in my account to buy what's on my shopping list for the week. Yeah, that makes sense. Excuse me. Dang, this is awesome. I actually didn't know this. So Shaping is only 18 years old. Good for you, my friend. I wish I would have started, or like really started and gotten serious when I was 18 years old. That's insane. Steve right here. My timing plan is to buy when Ryan and Russ tell me to. Steve, man, just buy whenever works for you. I like to do it every week. I think Russ does it every week. But Steve, man, once a month at a minimum, I'd say. But I know you got to be more consistent than that. I know you're in this stuff. KC here with an unpopular take. I don't believe in dollar cost averaging. Sometimes my best idea is cash, so I hold cash. I only buy when the stock price makes sense and I'm willing to wait. Yeah, and I think if I was deploying more money, well, no, that's not a good excuse, because instead of, you could always just not buy things, right? You could always just transfer money into your brokerage account and let that build until you see something really, really good, And that's different than even how I do it, even though I'm looking for a more attractive valuation. Sometimes it gets to a point where there's just it seems like there's nothing out there, you know what I mean? And actually, kind of on that note, there's been multiple periods of times where Warren Buffett has taken this approach where he's just sat on the sidelines and not, and they're playing with a lot more money, so I think it's easier to do. I don't know, I think, but there's been periods of times where he's just kind of sat on the sidelines and waited for opportunities. Like there was a period in the late 60s, I believe, when there were, I'm not going to get this quite right, but anything that said they were like technology, or maybe it was, anything that said they were like some sort of technology seemed to be like really booming stocks. They call them the go-go stocks in the 60s. And it was a period of time very similar to like the tech bubble or the dot-com bubble of the late 90s, 2000s, where anything that had a .com just ran up in valuation, and eventually that just popped and a lot of that stuff crashed. But during the 60s, when this was going on for Warren Buffett, he just sat on the sidelines until all of the madness kind of, moved past, and then finally there were some good discounts on the market. Then he had all this cash, a big war chest that he then went and deployed and scooped up all these discounts. But I know for me personally, I'm really actively trying to build that cash flow. And so I personally don't want to sit on the sidelines and wait for those big drops or really time it that way. Like take, how do I say this? Like initiate bigger positions. Like instead of just starting with one share or two shares here, just build up a war chest and then deploy it all at once, I don't know. I just I like being consistent every week. Not that that's right or wrong either, by the way. Okay, so Dan here says, I put money into my dividend portfolio every 2 weeks, and I allocate any dividends I have received into my investments where I think they're best used. Yeah, I do that as well. So that's another question I want to ask you guys too. How many of you guys out there have your dividend reinvestments automatically, have your drip turned on? Or how many of you guys manually reinvest your dividends into other positions? I personally, within the last, maybe 3 months or 4 months now, you guys can go back and look. I did a live stream about it. It was like one of the first live streams I did, I think. But I've had the drip off in my portfolio for a while, and I really like that. And like this last month, for example, you guys will see in this Sunday's video where I'm doing a portfolio update. Just because of dividends, like I was able to manually like reallocate about $200, which is a lot for me. Like an additional week's worth of investments into other positions in my portfolio, and that feels really cool. And I know that some of the dividends that came in, like I got one from, oh man, like I got a really nice one from AT&T. Did Starbucks pay? I don't remember if, yes, I got a nice one from Starbucks, and I felt a lot better just being able to put those into other things that I actually wanted to buy versus versus just putting them right back into Starbucks or AT&T, you know what I mean? Let's see here. Phil says, I invest every time I get paid. I split 50-50 with my investment money towards a 52 weeks low Canadian stocks. Okay, so he's looking for the valuation there, as long as it's under 5% of his portfolio, and the other half towards a US stock, same criteria. Okay, so this is kind of a little hybrid approach. So he's investing consistently, but he's also looking for discounts within his portfolio and also ones that are not too overweight. So there's kind of like a three-prong approach: consistent contribution with mindfulness towards valuation and also towards diversification. So all three of those are in mind for Phil. Lucas, how about $30 a day for 5 days? Yeah, that's fine too. That's fine too. And you could even do just like what, I mean, if it's easier, maybe like just do what Duke does or do what Ultra Runner does. Just instead of investing $30 every single day, just transfer like $150 a week and then deploy that across the 5-day period. Maybe that's what you do, and it was worded differently, but yeah, that works just fine too. Oh, dang, Caleb. I'm only 13 and have a Fidelity Youth account. Dang, man, that's incredible. Good for you. That's crazy. Okay, let's see here. Who else we got? Who else we got here? Shaping. So I'd actually do this too. I'm asking for money for Christmas, or for stocks for Christmas. I do that too. So you guys will have heard me tell the story before, but when I first got into investing, or my first portfolio, this Charles Schwab portfolio that I invest in today, was initially a custodian account that was made when I was like, I don't know, 11 or 12 years old. And it was the same thing. Every birthday, every Christmas, I'd get money towards my Charles Schwab, and would always just give my parents a hard time because it's like I just did not care about it being that young. I wanted an Xbox, you know? I wanted to play video games. That was pretty much it. But then as you get older, like it didn't hit me till I was like 25, 26 years old that I really started getting into this stuff. And upon doing so, then it switched, and I'm like, I don't need clothes. I don't need shoes. Like I'm good. I've got everything I need and then some. Just seriously, give me money to invest into my portfolio. And I don't know if, like, for those of you who are the same, like, I don't know if you get this too, but like my mom, she's so funny. She, you know, they get it. They get I love this stuff. But my mom's like, but I want you to have something that you can open on Christmas Day. And I'm like an actual, you know, like the shoes or presents or whatever. And I'm like, yeah, I get that. But I don't know. It just like, I don't know. I just don't always feel like I need more stuff. You guys know what I mean? Like I'd rather just have that money to put into the portfolio, or, you know, just have money to maybe use to travel or other things. Just, I don't know. As you get older, I think having stuff becomes less important, especially for what we're doing here with investing. I know just doing this, that's completely shifted how I think about like material things. You just see things, I think, from a different perspective, and a lot of like things don't mean as much anymore. Anyway, enough of that tangent. Let me keep going. Let's see. Lucas, I see a question about Enbridge. I'll take a look at that in just a moment, man, but I'm going to keep going through, taking a look at some of these dollar cost average comments. But yeah, remind me Enbridge if I don't get to it. And just a reminder, guys, it's 5:30 right now. I'm going to end up stopping the stream in about 15 minutes. So we're cutting a little bit short tonight, and I so apologize for that. But anyway, Inia here says, my goal is $500 weekly. Never thought we would be at this level in just 2 years investing. That's crazy. So you're investing $2,000 every single month. That's so awesome. Gosh, guys, and that's what I'm talking about. Like I would really working hard to increase my income to get to that level, but it's just a grind. It's just a grind. I got to be thankful though. I don't know how many of you guys know this, but for the last, I've talked about it a few times now, but for the last probably 3 months, I've actually been doing this YouTube thing like full time. It's like my only gig right now. And I told myself when moving to Vegas, I was going to try it out for a few months and just see if it'd be sustainable, see if I can keep my head above water financially. And I'm still not quite sure how it's going to work out yet. Worst case scenario, though, I think maybe I'll have to get like a part-time job or some sort of job on top of this, but nothing too crazy, which is honestly like such a I'm so blessed to be in this, even just in this position. And I know it's just a matter of time. Like as time goes on and the channel grows and more views come in and you do more things, the financially things just naturally have a way of growing, which is so awesome. But hey, actually on that note too, like thank you guys so much, because I would not be able to do this and I would not be here with all of you guys. So I actually think that deserves another toast. Let's drink to that. Here's to you guys, my cash flow companions. Okay, so let's see here. My man Mark, once a month is pretty good, and wait until OPEX, which is once a month and typically a red week. Okay. Yeah, he's once a month. Let's see, what else we got here? Okay, JD here says, buy every Friday, stocks and crypto. Wow, okay. Good stuff. Okay, so this seems to be like pretty much it for like the dollar cost average comments. Let me now, so Lucas, let me go address Enbridge. I'll be honest, I have not looked at this stock for a while, but we'll go check it out. We'll see what we can find out. So I believe it's an MLP, right? I could be wrong on that, but I believe it's a master limited partnership. I think I might be wrong on that actually. Yeah. Okay, I think I am wrong on that. Maybe it's not a master limited partnership, but it does seem to be in the midstream energy sector, or a midstream energy company. So they have a high yield, 6.5%. They do have a high payout ratio, like you said here. Nice 5-year growth rate, 7.47%. Fun fact, guys, this number right here, 747. I see this number everywhere. Every single day, morning and night, just I end up looking at the time at 747. I always see it on the clock. I see it everywhere. Maybe I check to see how many views a video has. It's 747 views. But anyway, this is a number that I see just everywhere. I don't know if you guys ever have those kind of trippy sometimes. But let's go take a look at Enbridge's financials real quick. So, okay, so it's kind of, I guess it actually would be trending upwards. They definitely have seen some growth in revenue across the last 10 years, and the gross profit does seem to be increasing, which is nice, by about threefold across the last 10 years, I'd say. Now, if we scroll down, let's take a look at what they're doing on an earnings per share basis. This seems to be increasing as well, for the most part, I'd say. The revenue per share is going down, but that's got to be because they're just issuing more shares here, which I'd have to do some more research to see if this is something that's common with a company like this. But at a glance, I'd say it's not the most ideal to see them issuing shares. Now, we know that there's some exceptions to this, right? Like real estate investment trusts, business development companies, it's pretty common practice to see them issuing shares, but I'm not sure if that's the case for a company like Enbridge. I guarantee Casey in the live chat has got the answer for us there. So Casey, enlighten us with that. Let's go look at the payout ratio too, because I know that was a cause for concern. And I got to say, like, it does look to be pretty consistent across the last 10 years. I mean, on the low end, their payout ratio was 70%. So it's not uncommon to see their payout ratio here over 100%. And I'm wondering if maybe it's that high just because of this type of business. And I don't know. Like I said, I'd have to spend some more time with Enbridge to really get to the bottom of what's going on. Let's see what they're doing on a book value basis. So book value per share saw a huge jump back in 2017, but has since kind of gone down a little bit. And this is going to be in part too to them just issuing more shares. So definitely something to keep in mind. The debt is increasing on this company as well by quite a substantial amount. It's almost tripled in the last 10 years, but that could be just due to them building out more infrastructure. I just don't know. Like I'd have to dive deeper into this. Now, it does seem to be, I'm going to read the description of this company again. It's an energy infrastructure company, pipelines, gas transmission, midstream. So it sounds pretty similar to what this other company that I have, EPD, does. Sounds exactly the same, actually. Another midstream company. They have pipelines, natural gas pipelines. They deal with a lot of natural gas liquids, stuff like that. But look at these dividend stats. I think you'll find them a lot better. Higher yield, I believe, right? 7.66%, because I think Enbridge had a 6 something yield. Payout ratio is looking better, about 80%, and I think it's consistently pretty high. So this is not too concerning. And because of the type of business, because of like how it's structured, it's an MLP, they're going to have a higher payout ratio anyway because they have to pay out their earnings to the partners. You're a limited partner with this type of security. The 5-year growth rate's not as nice, 2.43%, but they do have a much better dividend growth history of 23 straight years. Now, I know one of the things that keeps people out of investing in a company like EPD is the MLP status, but I've got to say, guys, well, actually taking a step back, because a lot of people see it as a headache come tax time because they send you a K-1 form instead of the dividends or the distributions just being included on your 1099, which is what you get for all of your other dividend stocks from your brokerage account at the end of the year. But I got to say, just this is going to be my 3rd year now doing my taxes, owning an MLP. And it's really not been that big of a deal. Like it's not much of a headache. And yeah, it's not worth not buying the company because of it, in my opinion. So that's just me personally. But anyway, let's move on from Enbridge. Okay. Actually, before we do that, Casey let us know Enbridge is an MLP. Okay. So the financials require a bit of adjustment if you want to fully understand. Okay, that makes sense. I couldn't tell just based on what Seeking Alpha was showing me if they were an MLP or not. It didn't look like it from what they were saying, but okay. Let's see here. Yeah, so actually going back to dollar cost averaging, I think if I'm understanding the context of this comment right, Charles says, the dividends are still buying at a higher valuation, so why should it matter? Basically saying that, no matter what price you buy at, you're still getting the same dividend. Yeah, that's true. So why should it matter? It just matters because like if you buy a stock at a higher price, it's maybe at a 4% dividend yield. If you buy it at a lower price, you might be able to get it at a 4.5% dividend yield or a higher cash flow return, which is important, I guess, to some investors. Like that's something I'm mindful of for sure. Let's see. But then on the other hand, there's people like Johnny who says he doesn't follow the dollar cost or basically the valuation sort of approach. Instead, he just buys shares and gets the dividend. As long as it's a good company, it doesn't matter. And I tend to agree with that. I think there's I think it's important to have a rough understanding of how a stock is valued and just relatively maybe where it's sitting at. Now, if a stock's intrinsic value, if a stock is trading at $100 per share, but its intrinsic value is, $95 per share, meaning it's, just a few percent overvalued, does that mean you should just wait? Maybe that's not too out of range to still buy. But, if a stock's intrinsic value is like undoubtedly like $95 per share, but it's trading at $200 per share, I think you're better off putting that money elsewhere and finding better opportunities. So it's just kind of a balance. Let's see. Keep going, guys. We've got about 7 more minutes left before we call it. And this is a good question too. So Hamed says, how would you play the week of CPI and Fed meetings on the week of the 12th? Gosh, I don't know. So, we saw, I believe it was earlier this week, right? Like that's why we had that big run up. So earlier this week, we saw a huge run up in the market because there were rumors of still rate hikes, but not as aggressive rate hikes. So instead of raising again by 0.75% or 75 basis points, they'd raise it 50 basis points. So they're still raising it, but just not as aggressive. And that sent stocks, shooting upwards. So we might see another, I don't know, like I'm not good at a lot of this part of it and trying to time things in this way. But, if that ends up being true and they only raise rates again by like 50 basis points, then it's possible that we might see stocks shoot up. Like if we see that rumor come to fruition, we might see stocks shoot up again. But then on the other hand, I don't know, I think there's just as much of a chance that they go down. So I really don't know. Like either way, they're going to react to whatever happens with the consumer price index and the Fed, whatever happens with the Fed meeting. So I don't know. Either buy it before or buy it after, just depending on what you think is going to happen. Let's see. So Brad here. Ryan, I recently had an analogy for building a dividend portfolio. It's like building a machine when you contribute. It's like adding a nut or bolt to part of your large machine helps keep me on track. Yeah, and actually, Brad, you guys stay with me 1 second. Don't mind my sweatpants here. Um, Gotta stay comfy when we're doing these streams. So, Brad, that makes me think of this book right here called The Income Factory. This is a book by Stephen Bavaria, and if you guys watch Russ's channel, if you watch Dapper Dividends, I think you'll have heard him talk about this recently. If you get my weekly email newsletter, which if you don't, link in the description to sign up for that. I just mentioned a video that talks about this book in this week's live stream. PPC Ian did an interview where the guest was talking about this book. But essentially what this book talks about, it's, Brad, it thinks about a portfolio in the same exact way. So you're thinking about it as a machine. Every contribution is an extra nut or bolt or extra piece added onto it. Well, this talks about it in the same way. Your portfolio is a factory that just continues to generate income, and your goal as the investor, the overseer of that factory, is to build it so the equipment never breaks down. So it's an all-weather portfolio. So no matter what's going on, you're still pumping out those dividends and creating that cash flow on a consistent basis. And definitely an interesting book. Like, it's by, I don't know if I mentioned the author, Stephen Bavaria. He's a Seeking Alpha writer, and he came out with his own book. It talks a lot about different types of securities, not regular stocks like we know. Maybe some BDCs in here, maybe some MLPs, but he talks very heavily about closed-end funds, which I think is a pretty advanced concept. It's something I need to revisit this book, because I first read it when I got into dividend investing, and I just didn't understand a lick of it. I didn't, to be honest with you, but I think, a few years later, like, that will have changed. So I definitely want to revisit it. But first, guys, I got to finish this heck of a book right here. This is House of Morgan. I've talked about this a little bit. House of Morgan, I don't know if you can tell how thick this is, but it's like 700 pages long, and I'm like not even halfway through. So I got that one. And then after House of Morgan, I'm going to read The Little Book of Valuation by Aswath Damodaran. Guys, love Aswath. Great YouTube channel. I think he's the Dean of Valuation at NYU, and he basically puts all his lectures out on YouTube. So not the most enjoyable watch, but definitely, like, you'll learn so much from watching those videos. And so I'm excited to dive into this book. Okay. Whew. Moving on. Let's see. Let's see here, guys. Couple more comments and we'll get out of here, okay? What do you guys got going on tonight? You guys got any big Friday night plans? Are you staying in? Yeah, so this is a good point too, I think. So DRIP is just another form of dollar cost averaging. Yeah. I leave it off. I'm a better capital allocator than random buying on dividend pay dates. I agree. And I think DRIP worked really well when I first got started. But I think you get to a point where you just want to have as much control as possible over where your funds are being allocated. And turning DRIP off, it just gives you that control. It's just another variable that you can use to your advantage when divvying up your funds, which is important for, I don't want to, I can't speak for everyone, but something like that is important for someone like myself who does not have a lot of money to invest. So I want to make sure I'm maximizing every dollar that I have going into my portfolio, whether it's through my own contributions or dividends. Let's see here. Okay. Ultra Runner, man, I am so sorry for the delay in this. I'm just now seeing this. Thank you for your hard work. Thank you so much for the super chat. I really appreciate that. You did not have to do that, but with that, thank you all once again for supporting me on this channel and always tuning into these live streams and always watching my videos and commenting. We have such a really great community here. The dividend investing community is like one of the best out there, and I'm so thankful to be a part of it. So, Ultra Runner, once again, thank you so much, man. You're a rock star. You guys all are rock stars. It's such a positive thing we're doing here, just creating this cash flow, and we're really setting ourselves up for a better future by doing this. Let's see here. One more comment, guys, and we'll call it a night. Let's see here. Okay. This is another good one. So would you think it's a good strategy to dollar cost average into only the stocks that pay out in 2 months' time to maximum? Okay, let me reread this. Would you think it's a good strategy to DCA into only the stocks that pay out in 2 months' time to maximize profit? I actually don't know that I understand that question, to be honest. Maybe you guys can help me make sense of that. But Gengar wants to know, Ryan, roughly how long did it take you to reach your current portfolio value? So I've been consistently investing since, gosh, October 2020. Probably maybe like late 2019, early 2020 consistently. But when I started being really consistent with it, at that time I had about, I think, $8,000 in my Charles Schwab, and then I had another maybe $6,000 or $7,000 in a Robinhood portfolio. That used to, like, before it was in Robinhood, it was in Stash. Before it was in Stash, it was in Acorns. And over the years, I just transferred it from one platform to another. And then what I ended up doing, you'll actually see this. I did this on my channel. I ended up, when I first started my channel, I had like 7K in Robinhood, maybe about 7, 8K in Charles Schwab. So I had about 15K total. And then I ended up combining them just into my one Charles Schwab portfolio. So, you know, with just being consistent, man, it took me about 3 years, I'd say, to get from about $15,000 invested to where it's at today, which is like $42,000. And I've pretty much been investing between $100 and $150 every single week in that 3 year period. Like, there's not been a week I missed. There's not been a week I've missed, but that's actually going to change. I'm going to talk more about that in this Sunday's video, guys. But so definitely stay tuned and check that out. But yeah, this month I actually will not be making any contributions in my portfolio this month. I'm kind of bummed about it, but it financially for me, it makes sense right now. I talk more about it in this Sunday's video, so stay tuned for that. Let's see. And guys, we're over the time limit here, so I gotta. Oh yeah, Gruder. I gotta get going, but I gotta address this. So Ryan, my number is 347. Really weird that you brought that up. Yeah, it's a pretty common thing from what I know my little brother has some sort of number too, where he just sees everywhere. And I don't know what it means, and I don't know if everyone has this, but yeah, 747 is my thing. I'll see it on the, like, I'll probably look at my exactly 2 hours from now. I'm gonna look at the clock just randomly, and it's gonna be 747. And I don't know, it's just interesting. So Jim here too. Jim, man, and I'm so sorry, guys. I'm so behind in all these. But Jim here, 750 super chat. I was going to give you $10, but since you're shorting us 15 minutes, Jim, thank you so much. I really appreciate you. You did not have to do that, but thank you. And I'm so sorry, guys. I don't know how I missed both those super chats and why I got so behind there. But anyway, this is where we're going to wrap it up, guys. I am so sorry once again for those late super chats, but thank you guys all so much for tuning in. I once again really appreciate all you guys, and I'm so sorry I had to cut this short tonight. Next week we'll be back on for another full hour, but I hope you guys have a fantastic night. Thank you once again for tuning in. You guys are awesome. Don't forget to hit the thumbs up button if you have not done so already. And also stay tuned for Sunday's video. It's going to be a portfolio update, my monthly portfolio update. And my portfolio right now, guys, is sitting at all-time highs. So I'm going to be talking all about that. Stay tuned. And you guys have a good weekend. And I'll see you in the next one.